Hello, and thank you so much for coming to watch the video today.
Yes, thanks for being here with us.
We're really thrilled to have you here. Today, our mission is to unpack the financial intricacies of a true corporate titan.
A massive one.
We are looking at the first 9 months operating results and the full-year forecasts for the global conglomerate, Mitsui and Company.
And the source material we're working through today, it's primarily drawn from the detailed presentations given by their CFO. That's Tetsuya Shigeta.
Right, and also the general manager of the Global Controller Division, Masao Kurihara.
Exactly. So we are going to distill the most vital takeaways from their financial disclosures for you.
And the central narrative we're pulling from these documents, it's a fascinating study in corporate balance.
It really is.
How does a massive multinational company navigate shifting global economies, U.S. tariff uncertainties, and a multi-million-dollar fabricated billing scandal?
Which is a crazy story we'll get into.
All while pouring trillions of yen into the future of global infrastructure. We are going to chart exactly how they manage that tightrope walk.
Because it serves as a masterclass in balancing short-term volatility with decade-long strategic planning.
Right.
When you parse through the raw data of these presentations, you see a company that is essentially acting as a shock absorber for the global economy.
Yeah, they're taking hits in certain legacy sectors while capitalizing on massive, well-timed gains in others.
Exactly.
Okay, let's unpack this. We have to start with the big financial picture and the upgraded guidance that CFO Tetsuya Shigeta presented.
The big numbers.
The overarching theme here seems to be resilience, but the presentation text points to a very cautious eye on the horizon. How does the actual cash generation stack up against their internal models?
Well, what's fascinating here is that while leadership is hyper-aware of lingering macroeconomic risks,
Like the tariffs.
right, specifically calling out developments surrounding U.S. tariff policies and ongoing geopolitical tensions, but despite that, their underlying financial engine is just roaring.
Roaring is the right word for it.
Mitsui's core operating cash flow, or COCF, as they refer to it in the ledgers, it hit an immense 748.8 billion yen for the first 9 months.
748.8 billion yen.
Yeah. They're generating cash at a velocity that is beating their own internal projections.
Which is a staggering amount of liquidity moving through the business. It sounds like a pace that would force them to redraw their roadmaps for the rest of the year.
And they did exactly that. You have to keep in mind, they had already revised their forecast upward back in the second quarter.
Oh, right.
But because this cash flow generation remains so relentless with segments like mineral and metal resources, energy, machinery, and infrastructure, and iron and steel, they're all tracking at over 80% progress against that previous forecast.
So they're cruising past the benchmarks.
Yeah, so they're revising their full-year forecast upward yet again. They bumped the projection up by another 50 billion yen,
Wow.
bringing the new full-year target for core operating cash flow to 950 billion yen.
So the cash is flowing significantly better than expected. But any student of corporate finance knows cash flow does not equal profit.
Very true.
Where do the actual profit margins sit for this 9-month period?
For the first 9 months, their profit sits at 611.9 billion yen.
Okay.
And while they confidently bumped up the cash flow forecast, they are actually maintaining their previous full-year profit forecast of 820 billion yen.
Making sure they hit the target they set.
Exactly. They noted that profit has progressed steadily across the board, which keeps them comfortably on track to hit that 820 billion yen target.
But maintaining that trajectory wasn't entirely without friction, was it?
No, not at all. There was a significant unexpected hurdle buried in the third quarter numbers.
And here's where it gets really interesting. In a report filled with, standard corporate financial language, there is this highly unusual and dramatic detail regarding a massive one-time loss.
Yeah, the Kazumi Global situation.
Right. The presentation points directly to this Kazumi Global scandal. Walk me through the mechanics of what actually went wrong there.
Okay, so in their Innovation and Corporate Development segment, Mitsui had to record a 34.1 billion yen one-time loss.
Just in the third quarter alone.
Just in Q3. And this was explicitly tied to a company called JA Mitsui Leasing, or JML.
Got it.
The core issue centers around the recoverability of receivables from a counterparty of one of JML's group companies.
And that counterparty is Kazumi Global.
That's the one. The presentation language here is stark. It explicitly points to emerging indications of possible inflated and fabricated billing or multiple assignments.
Let's decode that for a moment. Because when a financial report cites multiple assignments, What kind of operational failure are we actually looking at?
It implies a severe breach of trust and compliance.
A scam, basically.
Essentially, yes.
Uh,
In corporate leasing and finance, an assignment typically involves pledging a receivable or an asset as collateral for a loan or a line of credit.
okay, making sure the loan is backed up.
Right. But when they say multiple assignments, they are suggesting that Kazumi Global might have pledged the exact same collateral to multiple different lenders simultaneously.
Wow. So borrowing against the same asset over and over.
Yes. If a company fabricates billing to show revenue that doesn't exist and then borrows against that phantom revenue multiple times over the entire financial structure, collapses the moment one lender asks for their money back.
It's a house of cards.
Exactly. Because of these emerging indications, JA Mitsui Leasing had to record a provision for doubtful accounts.
Meaning they had to write it off.
Essentially, they had to admit on their balance sheet that a massive chunk of this money might simply be gone forever.
Hence the 34.1 billion yen crater in the quarterly profit. I mean, it is rare to see language that blunt on an earnings call. Did they have any advanced warning that this counterparty was a house of cards?
The CFO mentioned this amount actually includes an approximately 3 billion yen impact that they had already baked into their full-year forecast back in the second quarter.
So they saw some smoke before the fire.
They saw early warning signs and provisioned a small amount, yes, but the full scope of the fabricated billing indications seemingly blew up in the third quarter.
And what's their recourse now?
Well, JML is currently making every effort to recover those receivables. And Mitsui itself stated it plans to take appropriate actions as a shareholder to address the fallout.
If we connect this to the bigger picture, this situation perfectly illustrates a fundamental truth of managing global conglomerates.
How so?
You can have an incredibly diversified portfolio spread across energy, metals, chemicals, and infrastructure.
Right.
But individual counterparty risk can still suddenly materialize and take a 34 billion yen bite out of your quarter.
It's the inherent risk of doing business at that scale.
For most mid-sized companies, a sudden 34 billion yen write-off is an extinction-level event. But for Mitsui, it's a speed bump.
It really is.
The fact that their armor is thick enough to absorb a shock like that and still maintain an 820 billion yen full-year profit forecast is wild.
It speaks entirely to the sheer scale of their other operations.
The buffer is just massive.
The cash engine is running so hot elsewhere that it effectively papers over a 9-figure compliance disaster.
Yeah.
To really understand how they manage that level of buoyancy, we have to look under the hood at the individual business segments that are actually generating this cash.
Let's do that. Yeah. Masao Kurihara, the general manager of the Global Controller Division, provided the granular segment breakdown.
He did.
And for you, trying to make sense of the financial cross-currents, the contrast between cash flow and profit in these individual segments can seem contradictory at first glance.
It can definitely look confusing on paper.
Take the energy segment, for example.
Yeah.
The core operating cash flow was actually down by 62.3 billion yen compared to the previous year.
A huge drop in cash.
Yet, the profit for the energy segment was up by 14.6 billion yen. How do you book higher profits when the actual cash coming in drops by over 60 billion?
It comes down to a quirk in accounting timing, specifically something they call a swing back.
The swing back.
Right. The drop in cash flow looks severe, but it was largely due to a swing back of large LNG dividends.
Liquefied natural gas.
Yes. Mitsui received these massive dividends in the previous year because payments meant for the fiscal year ending March 2024 were delayed into the fiscal year ending March 2025.
Ah, I see.
So the cash flow comparison looks poor simply because last year's baseline was artificially inflated. The delayed payments landed all at once.
Making this year look worse by comparison.
Exactly. But when you look at the actual profit generation, things were incredibly strong.
Because of the profit bump.
Profit climbed by 14.6 billion yen because they benefited heavily from higher U.S. gas prices and an absence of impairment losses that had dragged down the previous year's numbers.
So they get a clean slate on impairments and a boost from American energy prices, making the profit look fantastic despite the cash flow illusion.
That's the perfect way to summarize it.
Moving over to the mineral and metal resources segment, the story seems much more grim. Both cash flow and profit saw steep declines, with profit down 29.5 billion yen.
The downward trend there is a direct reflection of broader macroeconomic realities.
The global markets just weren't cooperating.
No, they're facing lower market prices for metallurgical coal and iron ore, coupled with higher costs and lower production volumes for copper.
A double whammy of lower prices and higher costs.
They did manage to secure a boost from higher dividends from Vale, that's the massive Brazilian mining operation.
Right.
But those dividends weren't enough to offset the broader drop in global commodity prices for raw industrial materials.
Synthesizing those two segments together gives us a clear takeaway of Mitsui's hedging strategy.
How they balance the scales.
They are essentially using the windfall from U.S. gas operations to completely mask the bleeding in legacy industrial metals. It's a perfect internal counterbalance.
It's exactly why they diversify so heavily.
Then we have the machinery and infrastructure segment, which showed another distinct split. Cash flow was up by 20.6 billion yen, but profit was down 23.9 billion yen.
Right. The profit drop in machinery and infrastructure was primarily driven by the absence of asset sales compared to the previous period.
They just didn't sell as much stuff.
Exactly. Last year, they successfully sold off various assets and booked the profit. This year, they didn't execute those same sales, so the year-over-year comparison suffers.
Which makes sense.
This brings up the concept of asset recycling, a term that appears frequently in their strategy.
What does that look like in practice?
Asset recycling is essentially pruning the corporate tree. A conglomerate like Mitsui will sell off stakes in mature projects that have peaked in value.
To cash out.
Right, using those profits to free up capital for new early-stage ventures. Because they recycled fewer assets this quarter, the profit dipped.
But it wasn't all bad news in that segment.
No, they did note some significant wins in this segment, specifically valuation gains related to the Firefly IPO and higher profits from their automotive divisions.
Hovering over all these specific operational results are the massive macroeconomic factors: foreign exchange rates and commodity prices.
The invisible hands moving the numbers.
We know an organization of this size doesn't operate in a vacuum. How did the broader macro environment impact the bottom line for these first 9 months?
The macroeconomic environment was generally a headwind. A stronger yen pulled their profits down by about 9 billion yen.
That hurts exports.
It does. Additionally, overall commodity prices caused a net decrease of 11 billion yen, primarily due to those lower coal and iron ore prices we discussed earlier.
So a combined hit.
Yeah, combined, the broader commodity slump and the forex drag took a 20 billion yen bite out of their profit in the first 9 months.
But the forecast for the full year paints a completely different picture for those macro factors. They're expecting a massive swing.
They are. Looking ahead to the end of the fiscal year, they expect the macroeconomic winds to shift rapidly in their favor.
What's the projection?
They are officially forecasting a 28 billion yen boost from commodity prices and foreign exchange.
So making all that back and then some.
Their models anticipate this will be driven by higher global prices for iron ore, copper, and U.S. gas, combined with a weaker yen.
It shows how a global trading house can see its fortunes shift by tens of billions of yen based entirely on currency fluctuations and raw material pricing.
It's a wild ride.
So what does this all mean? We've talked about all this cash coming in. They're projecting 950 billion yen in total cash inflows.
A mountain of cash.
But a company with this kind of strategic mandate doesn't just sit on a mountain of cash. They are deploying it at a breathtaking pace.
Let's look at how they're investing for the year 2030 and beyond.
The cash outflows are where you really see the scale of Mitsui's ambition.
The spending side of the ledger.
Against that 950 billion yen in inflows, they reported massive cash outflows totaling 1.44 trillion yen.
1.4 trillion.
Yes, the vast majority of that capital, 1.2 trillion yen, was poured directly into investments and loans.
They are aggressively executing carefully selected investments for growth, specifically aimed at the long-term enhancement of their earnings base for their next medium-term management plan.
Committing 1.2 trillion yen to investments in the current global interest rate environment is a massive display of confidence.
It's a huge bet on the future.
Let's break down some of the key mega projects they highlighted to justify that spend, starting with the Rose Ridge Iron Ore project. What is the timeline and scale they're targeting there?
Rose Ridge is a monumental undertaking. Mitsui completed the acquisition of their interest in the project during the third quarter.
Okay.
Based on highly favorable results from a pre-feasibility study, they have officially decided to move forward to a comprehensive feasibility study to develop the iron deposits.
So they're moving to the next stage of planning.
Right. This comprehensive study is a critical multi-year milestone required before they make a final investment decision. They are assessing the development of an initial production stage that would yield an immense 40 to 50 million tons of iron ore per year.
40 to 50 million tons? That's a staggering volume.
And the timeline is just as impressive. The study itself is slated for completion in 2029, with the aggressive goal of producing the first ore by 2030.
They are essentially spending billions today to secure an industrial foothold that won't produce a single ton of product for another 6 years.
That's the nature of these mega projects.
And it's not just iron ore. They're also heavily involved in the Mozambique LNG project. The source text notes some serious geopolitical complexities surrounding this one.
Yeah, the Mozambique LNG project had been stalled under a declaration of force majeure due to severe security issues and instability in the region.
Basically, it was too dangerous to operate.
Exactly. But the presentation highlights a major turning point. The force majeure was officially lifted in November 2025.
Oh, wow.
This was following documented improvements in security conditions around the project site. Consequently, a restart of all activities, including heavy construction, was announced for January 29th.
So they're back to work.
They are. Despite the years of delays and regional instability, Mitsui continues to target commencing production at the Mozambique facility by 2029.
We have iron ore targeted for 2030 and liquefied natural gas targeted for 2029.
Long timelines.
And then there's a project that looks even further into the future of global energy markets. The U.S. low-carbon ammonia project known as Blue Point.
Blue Point is a fascinating strategic pivot.
Why is that?
Well, Mitsui acquired certification for Japan's price gap support system from the Ministry of Economy, Trade and Industry, or MITSI.
Okay, government backing.
Exactly. This certification is the linchpin for the entire endeavor. Low-carbon ammonia is a critical next-generation fuel, but it is currently significantly more expensive to produce and transport than traditional fossil fuels.
The economics just don't work on their own yet.
Right. The price gap support system is essentially government backing designed to subsidize that cost difference, making the fuel commercially viable for buyers.
Bridging the gap, literally.
Exactly. Based on this newly certified business plan, Mitsui is going to work towards building a comprehensive low-carbon ammonia supply chain specifically routed for Japan.
Which is an absolute necessity for Japan's own national energy security and its aggressive decarbonization goals.
It's vital for them.
But funding all of this forward-looking infrastructure, Rose Ridge, the Mozambique restart, the Blue Point ammonia chain, it has a profound impact on Mitsui's balance sheet.
You can't spend 1.44 trillion yen without it leaving a mark.
You don't authorize 1.44 trillion yen in cash outflows without moving the needle on your corporate debt.
No, you don't. The balance sheet reflects a highly aggressive, debt-leveraged growth strategy.
What do the numbers look like?
By the end of the third quarter, Mitsui's net interest-bearing debt had increased by an astonishing 1.1 trillion yen, bringing their total debt load to 4.4 trillion yen.
4.4 trillion.
The CFO specifically noted that this spike was mainly due to the massive borrowings associated with acquiring their interest in the Rose Ridge project.
Taking on an additional 1.1 trillion yen in debt in a single 9-month window sounds alarming on its face. But context is the only thing that matters in corporate leverage.
Exactly.
How does that debt stack up against their equity growth?
You always have to look at debt in relation to equity to gauge true financial health. At the same time their debt was rising, their shareholder equity also surged by 0.9 trillion yen.
Almost matching it.
Almost, reaching a massive 8.4 trillion yen. This equity boost was driven by foreign exchange translation adjustments and a significant increase in the value of their financial assets.
So the portfolio went up in value.
Largely due to rising stock prices for their listed holdings, yes.
So when you balance the 4.4 trillion yen in debt against the 8.4 trillion yen in equity, where does that leave their leverage ratio?
It leaves them in an incredibly strong, highly flexible position.
What's the actual ratio?
As a result of these parallel movements, their net debt-to-equity ratio, or net DE ratio, sits at just 0.52 times.
0.52.
In the world of heavy industry and global trading, a DE ratio of 0.52 is considered profoundly healthy.
Plenty of breathing room.
It signals to the market that they are leveraging debt to fund major growth, but they are doing so with massive unused capacity and a fortress-like capital base.
And speaking of maintaining that capital base, we should highlight how they are treating their investors through all of this aggressive expansion.
The shareholders.
Despite the massive cash outflows for megaprojects, they are keeping a tight focus on shareholder returns. The 200 billion yen share repurchase program they announced back in the second quarter is progressing steadily.
They're buying back their own stock.
They plan to have that acquisition and cancellation completely wrapped up by the end of March 2026. They are actively shrinking the pool of available shares to boost the value for remaining investors.
The CFO made a point to emphasize that they are deeply committed to enhancing shareholder returns while maintaining a strict balance with these investments for growth.
It's a lot to juggle.
It is a delicate tightrope walk to fund 2030 infrastructure while paying 2026 dividends, but the DE ratio suggests they are managing it effectively.
To wrap things up at a high level, the main themes we've pulled from this extensive presentation paint a picture of an organization operating on two distinct timelines.
Short-term and long-term.
On the short-term front, Mitsui is proving that its immediate cash generation capabilities are robust enough to act as a massive buffer.
A 748 billion yen buffer.
They're absorbing completely unexpected multi-billion yen shocks, like the Kazumi Global fabricated billing scandal at GA Mitsui Leasing, without derailing their 820 billion yen annual profit target.
It's incredible resilience.
And simultaneously, on the long-term front, that same cash engine gives them the confidence to take on over 1 trillion yen in new debt to fund decade-long infrastructure megaprojects like the Rose Ridge Iron Ore Mine and the Mozambique LNG facility.
This raises an important question and something for you to mull over after we wrap up today.
What's that?
We are looking at a company making multi-billion-dollar strategic investments in emerging technologies like low-carbon ammonia and massive LNG facilities, none of which are slated to produce their first product until 2029 or 2030.
Right.
When a modern megacorporation is laying out trillions of yen on that kind of delayed timeline, how much of their ultimate success relies on hard financial analysis, and how much relies on accurately predicting a global geopolitical and environmental landscape that doesn't even exist yet?
The future is completely unwritten, but companies like Mitsui are spending trillions of yen betting us. They know exactly how this story goes. Thank you so much for watching the video today.
It's been great exploring this with you.
If you liked the video, please make sure to click like, share the video, subscribe to the channel, and stay tuned for upcoming content. We've got plenty more insights to share. See you next time.